Yo, hello. Intro dia makin kemarin. Chris, what's up? How are you? So, Chris, like what I told you to draw, I know you'll be like, why am I so hard on you? You are getting it, but you're not understanding it very well the way I want you to understand. I need you to understand structure itself and how you can move forward with structure. You are getting it, but it's really no, you're not getting it the way I want you to. This is what I want you to draw on your listen on your book, and I want you to take a book, draw an uptrend, draw the inducement, and draw the liquidity. So in an uptrend, this is what an uptrend looks like. Yeah, this is what an uptrend looks like. What's this? So this is what an uptrend looks like. We have this. So this is an uptrend move, right? So where is our break of structure? This is our break of structure. This is our break of structure. You see, this is our break of structure. We have our point of interest here. Our point of interest is here. And after breaking structure, uh, after breaking structure, what do we have here? Here is the first pullback after breaking structure. So that's our inducement. That area becomes our inducement. So we have our inducement here. We have our inducement here. So we have our inducement there. So now this is a valid, like this is a valid buying setup. You get, this is a valid buying setup. If you see something like this, so this is what I want you to draw for me. This is the point of interest. This is the break of structure, and this is in the inducement. So when price comes back, this is the area where you are waiting to get confirmation from, and listen and buy from. So this can be. So what are you looking for before you take a trade? What are you looking for? This is a single leg. This is a single leg break of structure, by the way. You see this right here, we broke structure. There was no double leg. So what are you waiting for? You are just waiting for the inducement. After you had your break of structure, you are waiting for the inducement. And after the inducement, you are waiting to get an entry in the area. You're waiting to get an entry on that area. Simple as that. Do you understand? No, 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 no. You didn't do the same thing. You this thing. You didn't like. You were not this thing. Let me check what you. Where are you, sir? So you didn't like. You didn't break it. You had like. You didn't do. It's very simple. I need it to be plain like this. You see the way I mark out my this in my point of interest. You mark it out. The inducement you mark it out. The break of structure you also mark it out. You only give me there was no your inducement was at the high. The one you marked out that was not a good inducement. I wanted to mark it out simple like this. This is a single leg break of structure this in type of entry, and a double leg looks like this. A double leg looks like this. So a double leg looks like this. In your double leg, you have point of interest number one and point of interest number two. You get so you have your break of structure. Have your break of structure here, and you have your inducement here. So in a double leg, because this has an inducement already, you are looking for this area. You are looking for confirmation around this area or this area to take your buy from. You get you can come and sweep here before we eventually get here, but you are looking for confirmation around here to take your buy from. Simple as that. You get so you always mark out your point of interest, your break of structure, and your inducement. You can have something like this. You can have something like this. Uh, you can have something like this. You can have something like this. You see, this is this thing, a triple break of this thing, like this is a triple leg break of structure. And if you pick, let's say you pick this as your inducements after breaking this structure, but you are not looking at the overall structure. This is the main external structure here. This one is just internal structure and is a fake out. So you need to look at the overall structure of the market. You need to look at the overall structure of the market when you are picking your break of structure. You look at because this is an internal structure and this is the external structure. So we have 3 points of interest here. But the reason why we have this is that a lot of people will mark their break of structure here. They pick this as a break of structure here, and they'll pick this as their inducement, and they'll be looking to take a trade here. And eventually the market will come and stop them out and actually trigger the buy here. The reason being you did not pick the right break of structure. You picked the internal break of structure, you do not pick the external break of structure. So if this is your break of structure, then you are not looking at the overall structure of the market. So that's it. So you need to know like so you need to I needed to draw a scenario of three of all the legs of break of structure that I've taught you guys. I need you to draw a scenario for them and place the inducement break of structure point of interest. Draw it out the way I draw this of all the scenario on the bearish scenario and the bullish scenario. I need you to draw it out. That's what I want from you. You need to draw it out and detail it very well. Do you understand? So That's what I want you. That's what I want from you. This is the details that I'm telling you. You draw it out. You mark your break of structure, point of interest, and BOS. And I want to teach you guys directional bias. Took a trade today on BTC. Like, why are you trading during the weekend? Why? This guy, like, take it easy. Your this thing, your urge for trading is going to cost you a lot. But is it on a real account or a demo account? Take a break. You need to learn how to work with it. Don't get addicted to the chart. You need to learn how to take a break from the chart, and wait for proper market structure to form before you take trades. And Bitcoin is not something you should actually be trading at your level. It's not something you should be trading at your level because it is highly volatile. And if you don't understand the overall structure of the market, the bias of the market, you are going to get stopped out a lot of time. So that is, and I want to teach you guys this thing. Yeah, I want to teach you directional bias, but I can't teach only you. I need to wait for Daniel. This is Daniel. Before I can teach you. It's in the directional bias, how to be in sync with the market. Because the way I trade, when I'm going into the week on any pair that I analyze, I already know the direction the pair is. If I like, if I don't if I don't know the direction of the pair that I'm entering, like let's say next week now I want to trade GBP JPY. If I don't know the direction of where GBP JPY is going, I'm not going to be trading GBP JPY because I only trade pairs that have clear direction. So I will be on the right side of the trend. And that I've told you so many times that if you want to be on the right side of the trend, you need to always follow the higher time frame, which is the one this in the daily and the 4 hour. Those are the higher time frame. Me, I go as far as the weekly and the monthly, but for now you won't have that patience to go to follow the weekly and monthly bias. So just your daily direction and your 4 hour direction is very, very important. You see, if the 4 hour and daily is bullish, even if you see a perfect sell setup on the 15 minutes or the 5 minutes, it's a fake out. You are going to be stopped out. So you need to always follow the 4 hour and the daily direction. So if you are looking for a break of structure and market structure shift to enter any trade, you need to know that this break of structure that you are looking for it to align with the higher time frame. If you are not aligning it with the higher time frame, you are on the wrong side of the trade and you're going to lose that trade. So you mark support and resistance, like where is your support and resistance? And this is the 1 minute time frame. Like, have I ever told you, like, hey, tell you what's up? Ever, have you ever seen me show something on the 1 minute time frame? The 1 minute time frame is the time frame is for scalpers. Am I teaching you how to scalp? I'm not teaching you. I'm teaching you how to be a day trader or intraday trader. So don't have the idea of actually being a 1 minute person. Support and resistance. How would you be trading support and resistance on the 1 minute time frame? It's a very, very wrong time frame to be trading from. Your support, if you're marking out your support and resistance area, it needs to be at least the 4 hour. It needs to be at least the 4 hour. Those are the strongest support and resistance area. So any other thing that is within that is just a fake out. Any other support is just a temporary support. And if you are marking out a support, it needs to be a reaction from the stop trading in the 1 hour, remove the 1 hour. The minimum time frame you should be trading is the 5 minutes. So that's the minimum time frame. And don't do analysis on those time frame. Just your entry should be on those time frame. Your analysis should be for daily should be at least 15 minutes or 30 minute time frame. That should be your analysis for day trading. Don't get used to this. You feel like people are trading over 1 minute, they are cool, blah 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 blah. They are going to lose a lot of money, a lot of money. Tejuri, what's up now? How are you? How are you doing? Hello, 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 hello. We've missed you. Looks like you've been in school and you've been very very busy. So That's all right. You are lost. So tell me exactly where you this in where you um tell me exactly where you are lost at so we can like what can you remember. Yeah, have you seen, did you even watch the previous video that we had, the previous sessions that we had? Did you watch it? I already told you your this in your 4 hour or the 1 hour should be marking out your zones. If you are going to pick another block, if you are going to pick a support and resistance, it should be at least the 1 hour or 4 hour time frame. And if you drop to the 15 minute or 5 minutes, you're just looking for these structures, looking for this to align with the or with what you have marked out on the higher time frame already. So that's it. So Tertiary, like where yeah, I'm here with you, don't worry. Like what was the last thing you remember? Yeah, you're addicted. You're addicted and it's something like every beginner traders like go to, and you need to detach from the market before you become profitable. You need to detach from the market totally. If you are not detached from the market, you ain't gonna make shit. You don't like your feelings. You don't need to be happy when you are trading. You don't need to be sad. You don't need to have any emotion. You just need to have a system that you are ready to execute. And if it shows up, you execute. If it doesn't, don't do nothing. So point of interest. So Tertiary, this is it. So this is a single leg, a single leg move. I think you understand the concept of single leg, double leg, and triple leg break of structure, right? No, I'm not saying you should not learn. You should learn, but why are you trading on Sundays? Like, why? Why? So this is a single leg break of structure, a double leg and a triple leg. So this is how the scenario plays out when you've marked out your higher time frame this in direction already. When you've marked it out, this is the scenario that is going to play out. When you see a break of structure, let's say you're on the 15-minute time frame, that's where you want to be taking your trades from. So when you see a break of structure on the 15 minute, and when you are bullish, if you are bullish on the price, and you see on the 15-minute time frame, you already mark on the 4 hour or 1 hour time frame, you already mark your point of interest and anything. Let's say this is reacting from your point of interest, and we have a break of structure on the 15-minute time frame. What's the next thing you are looking for? You are looking for your structural liquidity, which is inducement. Do you know what inducement is, Treasury? So inducement is the first pullback after a market structure shift or a break of structure. That's the first pullback. So let's say this market break this structure now. We have our point of interest here. So the first pullback that people start buying from, that's the and for a valid inducement is must not touch any point of interest. If you have your point of interest here, it can only be valid as an inducement if it did not touch this point of interest. So if you have a break of structure here, you have an inducement, which is the first pullback. Now you are waiting for the market to come back because the market always takes out liquidity. We all know that. If you all know that by now, the market is always hunting for liquidity. So the market has taken this high, it came back, created a false this thing. Now this is the inducement. It went up, take another this high, take broke another structure and take this high again. Now this is the area where we are looking for the market to come back, come and take out this low and start buying from here and start going up. So that's the single leg break of structure pattern. We are looking for the market to after this thing, after breaking this high and this is this is a false buy. If the market is going up here, this is the false buy, and it's introducing people to just come and buy. You get, just come and buy early. It's introducing this in people to come and buy early. So let's say people that are bullish on this pair, let's say you are trading gold now and you are bullish on gold. So some people will have, the retail traders will be very very excited because the market has given them, maybe they are waiting for a bullish confirmation or something. The market has, or if you have anything, the market has start buying from here. So they will wait and jump on this break here, anticipating that the market will not come back. But the market is creating a trap for them because this is not the area that the market is supposed to be buying from. The market is supposed to be buying from a point of interest, this in a support or resistance or a demand. You get, so the market will break that liquidity zone and come into that area and start buying, sweeping all the liquidity above here, all the breakout traders that are here, that swept them out, stop them out, and all these people that are buying from here, that's also taking them out before it come to the real point of interest and start buying from. So do you understand what inducement is now? Okay, so this is a scenario for a single leg break of structure. So this is how you are going to use, yeah, the first false pullback. The first pullback after break of structure, that's your inducement, that's your structural liquidity. And the market, if the market wants to move, it needs to take out liquidity before it goes to direction. So this is the single leg break of structure, this is the double leg break of structure, and this is the, okay, let me draw inducement on this triple leg. So this is the inducement also on this triple leg break of structure. You get, so, and I this thing I said something about this thing, internal structure and external structure. Do you understand the concept of internal structure and external structure? Okay, so this let me, so we have, let's say we have a market structure like this. Let's say we have this, okay, we have this, have this, have this, we have this. You get, so now we are looking for okay, we have this, now we have this, have this, have this, and we have this. You get, so now this is a downtrend. This is a scenario of a downtrend, right? So this high right here, because it was responsible for breaking this low, now this high, this is our external structure. All the point of interest at this high, those are our external structure. Okay, those are the structure that we're breaking. Listen, we're breaking structures. Get, it was responsible for this break of structure. This was also responsible for this break of structure, right? So the internal structure is like, let's say you are looking for a reversal or something. You see this, like, this is also a break of structure, right? But the reason why it's not strong is that it's still within this dealing range. It's still within this dealing range right here. So the structure is still internal, and your overall break of structure should be here until price breaks, until price break above, until price break above here. You get, until price break above here, all this break of structure is just internal structure. It has not broken any valid high or any something like that. So this is just like a sign of reversal. So some people will mark this as their break of structure. Let's say you are waiting for reversal. Some people will mark this as their break of structure. Some people will mark this as their break of structure, and they will mark here as their inducement, and here will be their point of interest. You get, here will be their point of interest. Here will be their point of interest, and they will mark this as their inducement. But the market will just come the market will now go break this high, come back, sweep here, because there are people that mark this as their point of interest, and also sweep here and come back to this real point of interest and start going the direction, because they were not paying attention to the external structure. They were paying attention to the internal structure. So this is the external break of structure, and this is the internal break of structure. So this is very weak, and this is the break of structure that you should be looking for. All these are the market generating liquidity. You get, the market is just generating liquidity inside this range. The market is not doing anything, it's just generating liquidity. Do you understand? Okay. So since you guys are two here, I want to teach you guys, like, I want to teach you guys directional bias, what directional bias is, before we get to we go to the chart, and I'll show you what directional bias is. So let me start with so let's say we have another block here. Let's say we have another block here, right? Which will serve as our resistance, and we have another other block here which will serve as our support, right? So we have this range that the market is trading within, right? So let's say we have this uptrend now. This is the 4-hour time frame. We have this uptrend. Well, market touched this support, and we change trend, start going up, start going up from here. You get, start going up till eventually the market gets to this resistance level. You get, if we touch this resistance level, then we have a change of a break of structure in the internal range. You get, and the market keeps coming down till it eventually touch this resistance. So the reason why a lot of people are not profitable, everybody knows this. Yeah, this is like a basic concept in the market. Everybody knows this. Like, this in the market is making higher high and higher low. But the reason why most people are not profitable is that, you see, they want to trade everything the market is doing, like, because they know that the market is now pulling back, they want to trade it. They know that the market is going up, they want to trade it. And that's very, very wrong. You need to have a certain direction that you have in mind that the market is going. We have a resistance here. If the market should resist around this area, the market is going up all the way here. We know this is the direction that the market is going next. So if we start buying here now, we will not change our buying bias till the market gets up here. You get, we know that if we start buying here, we will not stop buying till the market gets here. So what are you now looking for? You are just on the 4-hour, you've had your bias already. This is where the market is headed. This is the next resistance, or this is the next order block, or this is the next high that the market is going to take. So you already have that in your mind on the 4-hour time frame. So when you drop down to the 15-minute time frame, or 30 minutes, or 5 minutes, where you execute, what are you looking for? You are looking for this. This is what you are looking for, to just follow the trend, to just be on the same alignment with the trend. And if it is bearish also, you are also looking for the same thing. You get, this is the buying scenario. So you've confirmed your bias already. You know that this is where price is going. You don't have any business trying to sell. You don't have, some people want to sell this, buy, sell this. No, you are going to be stopped out. You don't have any business trying to sell this market until it reaches here. So you can, if the market takes 3 months before it reaches here, for that 3 months period, you are just looking for buy setups, and it's not going to show up every day. In a week, you might see two, three buy setups, and you take three, and you like you. If you take the three, you lose one. You listen, you win two. Very good. Trading is not that hard, It's not that hard. And sometimes if you've mastered the strategy already, you hit everything. But the most important thing is that you should know the direction that the market is going, so that you don't get stopped out. You don't have any financial power to trade against the market. You can never win if you are trading against the market. So when you're looking at your chart, that's why I tell you that, like, make your analysis on the higher time frame. Because if you make your analysis on the higher time frame, you have a clear direction where the market is going, and all you need to do is just follow where the market is going. And if you are buying from here, you have no business selling until the market gets here. So if you break this high, you are looking for a point of interest. If you break this high, you are looking for a point of interest. If you break this high, you are looking for a point of interest. You are looking for inducement, waiting for confirmation. That's just good. You get, so it's a very very this is it's very very simple. This is not about support and resistance. I'm just using support and resistance to listen. Support and resistance is basically order block, an area where price is not breaking above, and an area where price is not resisting. So it is not going to be support and resistance. Sometimes it's going to be an order block where price is not willing to go above. So support and resistance is just the way of the market. It's not this thing. If you've not learned support and resistance before, it's not the integrity. Just listen, look for an order block. The same way I taught you another block. Another block, that's the place where if price get to is actually price, just an area where price is reacting from on higher time frame. If price is reacting from, let's say you have another block where price is reacting from on a higher time frame, you know that this is the daily time frame. So it's going to take at least 2 to 3 months for it to get to take profit. If you are placing a trade there, you need to hold that trade for it to get to take profit. It's going to take like 3 months. So within the space of that 3 months, you are not looking for anything else. You're just looking to follow the market to where it's going on the lower time frame, because you on the higher time frame you already know where the market is going. So you drop the lower time frame and try to align your strategy with the direction on the higher time frame. It's as simple as that. Do you understand? You guys understand? Teju, do you understand? Yeah. I'll come with this thing. It's this thing. I just wanted to understand. So support and resistance means point of interest and other. Yeah, support and, like, what is the point of interest? A point of interest is where you are looking for market to react off of. You get, it's just where you are looking for the market to react off. So if you mark your order block and you mark your support and resistance, just an area where you see that price is rejecting. So if you have it marked out, you're just looking for a reaction to confirm. That's when you drop down to the lower time frame, looking for a break of structure, market structure shift, blah 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 blah, point of interest inducement before you actually get to the part. Do you understand? Tejuri and Chris, do you understand? Before I explain something to you. Okay, let me show you example of the directional bias on this in on the pair. And before I attend to Sean, please, I'm coming. So let's look at this the same example that I showed you now. I'm going to show you how I traded it on this euro pound, and how I was like how I just followed it. So this euro pound, yeah, we've been on a like we've been on an uptrend right here. We've been on an uptrend, and we were in an uptrend for a very long time. We're in an uptrend for a very long time. So we started the trend here, and we're in an uptrend for a very long time. So my bad. So we started the trend around here, and we were in an uptrend for a very long time, right? So the market from here, the market was going up. So you had no business trying to, sell this market unless you like understand this and how why this is pulling back or something. So as the market is going up, we have pullbacks and everything, right? So as the market is going up on the 4 hour time frame, all you need to do is just break of structure, point of interest, inducement. Break of structure, point of interest, inducement. Break of structure, point of interest, inducement. You're not going to see it very well on this 1 hour time frame, but if you drop down to the 15-minute time frame, you are going to say. So why did I, if this trend is bullish, why did I start selling from around here? So let's go to the 1 hour time frame and you see it, daily time frame, and you see why I started selling this pair. And the reason why I said you should mark out your other blocks as your point of interest. So this is the daily time frame, and we have look at here. This is the daily time frame. The same setup that I'm telling you. This other block was responsible for breaking structure here. Mind you, this is the daily time frame. Also, this is a data of about a year or something. It takes a year for this whole setup to complete. So this other block right here was responsible for breaking. Okay, so let me zoom it in for you guys. So this other block right here was responsible for breaking structure right here. So after we broke structure, the first pullback, yeah, this is the daily. So the first pullback, with that did not touch this other block. You see, that was where that was the inducement, and we sold all the way here. After selling all the way here, we started buying from here. And if we look at why are we buying from here, we started buying from here, right? And why did we start buying from here? It's the same thing. This other block was responsible for markets breaking all this high, and we had the inducement here. So we started buying from here, and the trend changed to come here that broke this high and the inducement. And once the market tapped that place, it started selling downwards again. So now, why? So let me just show you how you follow it once price get to that level, or how I followed it. So this is the daily time frame, yeah. So let's drop to the 1 hour time frame. So on the 1 hour time frame, we have this. So price got to this area. Price got to this area, which is the daily, the daily resistance or daily order block, right? So on the 1 hour time frame, now because you don't obviously you are not trying to trade like the daily, you are trying to get down to the lower time frame to see how you can enter. So on the 1 hour time frame, what was the first thing I was looking for? I was waiting for the market was in an uptrend, so I was waiting for the market to break the uptrend, and which is the first indication that I taught you guys. The first break, which is the change of character. We have the change of character here, and after the change of character, here, we had this inducement, this pullback. You see, we pull back and we came up again. So we pull back. Which area was responsible for breaking this structure last? Which order block do we have? We have this order block around here, but I personally didn't trade this because the market has not shifted totally. It has not broken structure. So the market came and broke structure here. You get it broke structure around here. After breaking, when we have the first change of character, then the second break will be our break of structure. You see, we have our break of structure here. And after we have our break of structure here, this is the 1 hour time frame. Now, which area was responsible for breaking the structure? This order block right here. That was when I started selling this pair. So this order block right here was responsible for breaking structure on the 1 hour time frame. So that was when I started selling this pair. And on the 1 hour time frame, we drop down to the 15-minute time frame. You see the setup very well. So on the 15-minute time frame, this is what you see. So this what you see on the 15-minute time frame. Last stop. So on the 15-minute time frame, we had this order block here, and it broke structure here. You get, so this order block right here that broke structure, we didn't have an inducement for it. So if you don't have an inducement for it, what do you wait? You wait for confirmations on the lower time frame, and once you had the confirmation, you sell from here. And this was also responsible for breaking this structure again. After breaking this structure, I told you guys I'm not going to teach you confirmations yet because I want you guys to actually know the structure before I start teaching you confirmation. So we had another break of structure downwards, and this is the same area that was responsible for breaking the structure downwards. And we have this first pullback, which was our inducement down here, and the market came back, tap us in, and we sold from here to here. The same, to like now we sold from here to here. To here now, I didn't have any setup. I think I had another setup around this place. You see, another set. This one is even marked out already. I had another setup around this place. We had this area that was responsible for breaking this structure low, and we had our inducements here, which are marked out here. And this area, you see, when price tapped in, that was when we sold all the way here. So just by following the trend, I was able to avoid any loss. I was able to avoid any loss on this particular pair, and I was able to catch like this whole price action was like I think a month worth of price action, and on this pair I was able to catch like 4 to 5 beautiful trades on this pair. I don't trade one pair. I have a lot of pair that I'm trading, and as a day trader, you don't have any problem looking for multiple trades in a week. Once you have 3 to 4 good trades in a week, you are okay. If you have a better good risk to reward ratio, which I'm going to get down to later, I'm going to like break the risk to reward ratio. I'm going to break it down for you guys. So do you understand? Okay, so that's going to be the lectures for today, and I need you. Yeah, I'll teach you guys. Don't worry. I need you guys to do this properly, and show me that you've gotten it properly before I teach you entries and breaking down risk management and everything. But if you guys did not do that, I'm not going to teach you anything. So that's going to be the lecture for today. And Tejiri and Chris, You guys can just you know, you guys can just go and focus on that. I'm about to start teaching another person something new, and you get, so you guys can clock out, and don't forget, do your assignment and send me the results. You can only earn, like, teaching you entries, you have to earn it. And so far so good. I'm not actually saying, like, I'm not, it's only Chris that is putting in the work, even though it's not, like, it's not following the right direction, but I know he will eventually get there, because you have curiosity as a beginner in trading. You have curiosity, that's very normal. You jump, 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 jump. But the most important thing is the hunger to learn. So eventually he will get there. Tell you, you've been busy with school, I understand, but still, you got to do your assignment. You understand? So yeah. So you guys, see you. So Sean, are you here? All right. So you guys send it, and multiple pairs, like multiple pairs. Do your analysis on multiple pairs, and I hope you've understood what a directional bias is. Yeah, yeah, in the group, like, everything should be in the group. So I hope you guys have understood what directional bias is, because I'm not going to talk about it again. I'm going to make some corrections, but I'm not going to teach you guys again. Hello, have you guys understood what? Ask your questions, please, 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 please. I don't have a lot of time like that. What I ask you to do now? The directional bias, of course. Like, go mark it out in your chart, and the single leg break of structure that I taught you guys. On which way did I even draw this thing out? Shit. Um, on which way? I think it's this way. Was this the one that I draw? The I'm trying to look for the pair that I did the markouts on for you guys. It's not directional bias, it's directional bias, like bias where the market is going. Yeah, so treasury is paying attention. It's directional, yeah, it's directional bias, not bias. Direction, like, it's how to be in the same direction. Like I said earlier, if you are going into any week as a trader and you don't know the direction of where that particular pair is going, you should not be trading that pair. So it's not as if you are going to the market in a day and you don't know what you want to do on the market, or you're just looking for, you are just guessing if the market is going to buy today or sell today. No, you should know where the market is going for the next 1 month, or for the next 10 days, for the next 1 week. You know exactly what the market is going to do, and you know exactly when it's going to do it. You predict it. It's not as if you know for certain, but you've predicted it already. So now you're just waiting for what you predict to happen for you to get into the trade. And if it did not happen, you move on to another trade. Yeah, it's not buy, it's bias, BIA. Yeah, BIAS. It's directional bias, the direction of the market, where the market is going. So that's where. So you guys should go and do your assignment, and send it to the group. Let's break it down. So Sheon, the market moves in three different directions. Three different directions. You have the uptrend, which means the market is going up. Shit, what's going on? I'll also add it to the group channel. I'm just talking about them. This is not about you. Now, this video now we have to start talking about you. So this the market is going like this. So this is an uptrend. This is if the market is going up. The market is not going to, if the market wants to buy, it's not going to buy straight like this. No, it's going to go in a zigzag way. In a zigzag way, it's going to be going like this, up and down, up and down, up and down. So that's what an uptrend is, and that's how the market moves in three ways. And we have a downtrend also. We have a downtrend also, which means the market is going down. So it's going to be going down. So this is up, this is down, and it moves in a zigzag way. You get it moves in a zigzag way, uptrend, downtrend. And we have the third one, which is the market will be ranging. The market is not going anywhere. It's just trading within particular price, refusing to break any high and refusing to break any low. So this is an uptrend. So this is an uptrend and this is a downtrend. And this we call it, you can call it a ranging or you can call it consolidating. You get, so this is ranging. If the market is trading within a particular price point, or consolidating. So this means the market is trading, what's going on? Okay, I think there was a problem with the stream, but it's back now. Shema, are you there? Okay, so the market, this is ranging, and this is an uptrend, and this is a downtrend. So this is the three ways the market moves. So anytime you are looking at the chart, anytime you open the forex market, these are the three things that you see. It's either the market is going up or is going down, or the market is just trading within the price range. So if the market is an uptrend, the market will be breaking the previous high, but it will not be breaking the lows. So it will be breaking this high. It will be breaking this high. This is the previous high. It broke it. It will come down and it will not break the low. It will respect the low. It must respect the low before we can say it's an uptrend. So it will respect it and it will break this one again, respect this one, and break this one, and also respect it. So it means the market is in an uptrend. The market is going up. So anything, if you see any market that is going in now, you should just be looking for how to buy, how to be a buyer. You're not looking to sell. You're just looking for places that you can enter, buy from. You can enter, sell from. Do you understand? Yes, about. So now, if the market is in an uptrend now, there's something we call point of interest, and that's just definition of it. It's a point that you are looking where an area where you are looking to take your buy from. If market is in an uptrend, it's an area where you are looking to buy from, and that was the first video that I sent you, which is the order block. So it's just a point of interest, and for a point of interest to be valid, it needs to be responsible for breaking structure. So this point of interest is valid because it broke this structure high right here. And this is also valid because it broke this structure. And this is also valid because it broke structure. So the point of interest is the last place that buyers start selling. So see it like this. Let's say sellers are in control now. They are selling this market and it got here. And buyers enter. They start buying now. And they were able to push and overtake these sellers. Now this point that they entered from, which is the order block I'm going to show you now, which is the order block, that is our point of interest. That is the area where we are looking to start buying from because we know that there is a buying power over there. You get, there is a buying power over there. So that is the area where we are looking. My listen is showing error. Can you hear me? Please, can you hear me? Let me know. Yeah, it's the network. My Wi-Fi is just there somehow. So the point of interest is an area where you are looking to buy from, an area that interests you, that if price gets to this area, I will be waiting for a reaction on that area for me to start buying from. So point of interest, that's an area where you are looking to buy from. So in a ranging market, you always mark out the point of interest. Sorry, the point of interest that was responsible for breaking structure. Okay, so you always mark it out. This is the point of interest, and this is responsible for breaking structure. Do you understand? You don't dey whine me with that oh. So the same thing on a downtrend. If price is going down, the same thing we have a break of structure and a point of interest. So we have this price is going down. We broke structure here. We broke structure here, and we broke structure here, and we also broke structure here. So our point of interest now is this last area. That's our point of interest because it was responsible for break structure. We have another point of interest here. We have another point of interest right here. So these are the areas where we are looking to just buy, to just sell from in a downtrend. These are the area where we are looking. If the market should come back here, there should be this thing. There are things that you will look for later, but let's just start from here. So this is an area where we are looking for to start selling from. If it's in an uptrend, this is an area where we are looking for to start buying from. And if it's in a downtrend, this is an area where we are looking for to start selling from. And in a ranging market, this just do it support and resistance. The market is resisting this area, and the market is supporting this area. Okay. I'm with you. I'm with you. Yeah, I'm with you. I'm with you. I'm with you. I can hear you. I can see your comment. Like, what question do you have? Waiting for your question. Yeah, in an uptrend, you are just buying. In an uptrend, you are just buying, and in a downtrend, you are just selling. Up, down, buying and selling. Nothing in between. An uptrend, you are buying. A downtrend, you are selling. Nothing in between. And in a ranging market, the market is ranging between here and here. So the market is not willing to go above here and is not willing to go below here. So you now have 2 points of interest. You are looking at a possible sell from here and a possible buy from here if you have the confirmation and everything that is needed. But you have 2 points of interest in a ranging market, and you have this thing as a resistance and you have a support. Resistance, like if something is going like this and it meets a resistance, like just the ceiling of the house and the floor of the house. The resistance is the ceiling and support is the floor of the house. Something is not willing to go below and something is not willing to go above. So not in a range. The market is not, it's just ranging. There's no trend, it's just trading between up and down, but it's not willing to go above Okay, let's say the price is not willing to go above 4,500 and it's not willing to go below 4,000. So now the price of that particular thing is between 4,000 to 4,500. It's not willing to go above and it's not willing to go below. So you cannot buy it for 3,900 and you cannot buy it for 4,600. It's between 4,000 to 4,500. Do you understand? Yeah. Yeah, that's why it's called ranging and consolidating. Yeah, so that's the range of the price. No, it's not going above this and it's not. So that's the range of the price. If you understand, so let me just show you examples on the chart. And, so should I show you examples on the chart here? You understand the concept now. I should show you on the chart here. All right. So okay, let's go to let's go to Bitcoin. Let me show you the example on the chart. So Bitcoin has been in a downtrend. Sorry. So Bitcoin right now has been. You want to move? Okay. I. So Bitcoin now has been in a downtrend now like this. You get. So Bitcoin is in a downtrend now. From here to here, we are only looking to sell Bitcoin. So I don't worry. Let me just quickly break it down for you. So now we are we're in a downtrend right now, right? So this is the break of structure that we have because we've been on a downtrend. We broke structure here. We broke structure here, and this is our point of interest because this was the last buying candle before we start pushing down. You get, so we broke structure here. This is our point of interest, and we have another break of structure here, which is this. So this is our new point of interest because this was the last buying candle before sellers come. This was the last buying candle. So we broke another structure here. We broke another structure here. And this is also our point of interest. You get, this is also our point of interest. So on the downtrend, you see the point of interest that we're marking. So those areas are where if price get there, they are very very key areas. If price get there, we are looking to sell from. And this is the example of a ranging market. Let's talk about this and we'll call it a day. This ranging market. So this is the example of a ranging market. You see, price is not willing to go. Price has been ranging from this price now. Price is not willing to go above this and it's not willing to go below this place. So now it's ranging. You get, this is an example of a ranging market. So now price is ranging. So if price comes here, we are looking to sell, and if price comes here, we are looking to buy if we have the right confirmation. And until price break above this, we are not buying. We are not looking to buy aggressively, and until price break below this, we are not looking to sell aggressively. So if price should break above this, it's coming for all displays. So that's and the same thing on this in downtrend. That's the same thing on the uptrend. So let's just stop it there, and we'll talk about it later. So do you understand? Before I go, yes, no. Before I go. All right. So talk about another things later. If you understand this, we'll talk about it. When you we'll talk later in the night, and I'll tell you what to do. So to just show that you've understand it, then we'll move to the next topic. All right. So, bye bye.